Welcome to Celebrity Investing, your go-to source for insights, tips and updates on navigating the exciting landscape of personal and global finance. Please like, share and subscribe for more exclusive content. This is part 2 of the Beginner's Guide to Convertible Bonds. Market risk. When it comes to convertible bonds, market risk is a significant factor. Think of market risk as the unpredictable waves of the financial ocean which can sway your investment up or down. As the stock market fluctuates, so does the value of convertible bonds. If the underlying stock price tanks, the bond's conversion option becomes worthless and it might trade like a regular bond. Even though they provide interest income, the bond's market value can decrease if investor sentiment turns negative. This linkage to a company's stock performance means that market volatility can heavily impact their price. Credit risk. Credit risk is another important consideration for those investing in convertible bonds. At its core, credit risk is about trust. Trust that the issuer will repay the bond and its interest at maturity. If the issuing company encounters financial troubles, there's a chance they might default. This would affect not just the current bondholders, but also those considering conversion to stock. Convertible bonds issued by financially unstable companies often offer higher yields to compensate for this risk, but this should be a red flag. It's like lending money to a friend with a sketchy track record. The risk of not getting it back remains high. Dilution risk. Dilution risk centers around what happens when bonds are converted into equity. Simply put, if a large number of convertible bonds are exchanged for stocks, the existing shareholders feel the pinch, like adding water to soup, thinning the flavor. This process increases the total number of shares, thus reducing the percentage ownership of each existing shareholder. For investors holding the stock, this dilution can decrease earnings per share and potentially weaken the stock's value. Even if convertibles appear lucrative, one must weigh the conversion impact on existing shares. Ask yourself, is the pie big enough to share without losing too much of your slice? Understanding these risks helps investors determine if the potential rewards align with their financial goals and risk tolerance. As you consider convertible bonds, keep these factors in mind to navigate this investment option wisely. Strategic uses of convertible bonds. Convertible bonds aren't just for investors aiming to balance risk and reward. They're vital financial tools for companies and investors, serving as strategic arsenal for various financial goals. Understanding their tactical applications can help both parties navigate their distinct financial landscapes with finesse. Capital raising for growth. Picture a company with sky-high ambitions but constrained by limited capital. Convertible bonds can be their golden ticket to fund expansion without immediate equity dilution. By issuing these bonds, a company can secure much-needed funds while keeping shareholders happy, since new stock isn't issued right away. Convertible bonds offer a lower interest cost compared to regular debt, making them a cheaper financing alternative. They entice investors with the potential for equity conversion, allowing companies to raise funds while maintaining a manageable debt load. This approach often appeals to firms in volatile industries or growth sectors where stock price spikes are expected, paving the way for conversion opportunities investors can't resist. As the company scales and its stock value increases, those bonds can be converted, ultimately raising equity without a heavy initial compromise. It's like having your cake and eating it too. Immediate capital with potential for future equity with no upfront equity sacrifice. Portfolio diversification. For investors, the allure of convertible bonds lies in the opportunity to diversify risk and reward profiles. By adding these hybrid instruments to their portfolios, they get more than just a mix of stocks and bonds. Convertible bonds serve as a bridge, offering both steady income and equity growth possibilities. When it comes to spreading risk, think of them as the Swiss Army knife of investments. They offer interest, income. Like traditional bonds, they pay consistent interest, providing a safety net against stock market dips. Equity upside. If the issuing company's stock takes off, investors can convert the bonds, capturing the upside potential. Investors often turn to convertible bonds to weather uncertain markets, balancing secure income with a shot at equity gains. This dual nature helps hedge against market volatility, providing a buffer across unpredictable investment climates. It's a win-win, blending security with potential, much like having an insurance policy that doubles as an investment opportunity. By using convertible bonds strategically, both companies and investors can position themselves to capitalize on financial opportunities while safeguarding against potential pitfalls. Tax considerations for convertible bonds. Convertible bonds offer a fascinating blend of securities, but they don't just come with financial perks. They also carry unique tax implications. If you're diving into the world of convertible bonds, it's crucial to know how taxes can affect your returns. Let's break this down into bite-sized pieces so you can navigate this terrain with confidence. Interest income. Convertible bonds at their core are still bonds, meaning they pay interest regularly. But there's a catch. This interest is typically taxed as ordinary income, which could be higher than capital gains tax rates. So what's the takeaway? Treat your convertible bond interest like salary earnings when considering your annual tax return. Here's what to keep in mind. Tax rate. Interest income from convertible bonds falls under the ordinary income tax bracket. This could be as high as your highest marginal tax rate. Timing. You pay taxes on this income in the year you receive it, regardless of whether you reinvest it or not. Capital gains. When you convert bonds into equity or sell them at a profit, capital gains tax enters the picture. This tax is generally lower than ordinary income tax, offering a silver lining in maximizing your returns. What should you be aware of? Short versus long term. If you hold your bonds for over a year before selling or converting, you benefit from the lower long-term capital gains tax. Less than a year? You'll face the higher short-term rate, often likened to your regular income tax. Conversion impact. Converting bonds into stocks isn't an automatic taxable event. But if you decide to sell those shares later on, you'll pay capital gains tax on any profit from the original conversion price. Tax strategies. Smart investors don't just think of profits, they think of tax implications too. Here are strategies to optimize your tax situation with convertible bonds. Tax-deferred accounts. Consider holding convertible bonds in tax-deferred accounts like IRAs. This way, you only deal with taxes upon withdrawal, potentially at lower rates due to retirement income levels. Tax loss harvesting. Offset capital gains with losses from other investments. This could mean selling underperforming assets at a loss to counterbalance taxable gains from your bonds. Stay updated. Tax laws evolve, and you don't want surprises. Keep an eye on changes that might affect your convertible bond investments, or consult a tax professional if you're unsure. Remember, while convertible bonds can be an exciting addition to your portfolio, they come with twists in the tax department. Understanding these implications helps you make informed choices, ensuring your investment journey is both savvy and tax efficient. Market trends and future outlook. Convertible bonds continue to capture investor attention with their unique balance of risk and opportunity. As the financial market evolves, these instruments are more than just a reliable choice. They're becoming a strategic asset in uncertain times. Let's dive into how current trends shape the convertible bond market and what the future might hold. Increasing popularity among investors. In recent years, convertible bonds have become increasingly popular among a diverse group of investors. Why is this happening? For starters, they offer a sweet mix of securities, cushioning portfolios against market volatility while allowing participation in equity gains. With low interest rates, investors look for alternatives that provide more than the usual bond returns. Convertible bonds fit the bill perfectly by providing income along with growth potential. This hybrid asset's ability to adapt to market conditions is akin to having a financial tool that is both a shield and a sword. Shift towards ESG-conscious investments. Environmental, social and governance (ESG) factors are gaining traction across the investment community, and convertible bonds aren't lagging behind. Companies focused on sustainability and responsible practices benefit from issuing convertibles, attracting ESG-focused investors. By aligning financial instruments with ethical considerations, these bonds reflect a broader trend in the financial world towards sustainable growth. As more firms aim to meet ESG criteria, expect associated convertibles to rise in popularity. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like and share to continue your journey to financial success.